This is the current federal tax developments for the week of September the 3rd, 2024. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. This week, we got a couple things to look at here as we're going through the Memorial Day week, or I should say the Labor Day weekend, end of summer, not beginning of summer. And as would kind of be expected heading into the 3-day weekend, we didn't have a lot going on in federal taxes this week. So while we'll talk about one particular thing that came up, we're also going to kind of do a review because there is a topic I see that's come up multiple times on discussion forums I thought we'd want to look at this week. So what we'll talk about first is Department of Justice has scheduled a December 2nd hearing on proposed rule to reschedule marijuana. Now, that has implications because the final rule obviously cannot really come out before that hearing date. So it means we're probably looking at next year as a time where that rescheduling will take place. And that will open up a lot of questions about what happens for like calendar year 2024 returns, various other issues in that area, assuming we do get the changes we have. Plus, if there is a change in administrations, well, there's going to be a change in administrations in January eventually, because we know that the current incumbent now is not running for re-election. So the question is going to become, will the new administration have any different views on this? We might presume that the current vice president is likely not going to have different views on this. Whether the Republican candidate would have the same view might be a different question. We'll just have to wait and see. But obviously, it could be another administration. And the one thing people don't like in an industry is uncertainty. So this kind of adds to that. And second, I want to talk about BOI reporting. I've had a lot of confusion when I've run into discussions and questions on various discussion groups related to tax on the internet, both state society ones and otherwise, where I keep seeing the same mistake being made over and over by individuals with a tax background of confusing legal entities and tax entities, as well as not necessarily understanding that ownership is, as far as the government's concerned, is an individual attribute, not a something where a entity can own another entity. It can. We're going to look through to find individuals always for beneficial owners. So we'll talk a bit about those issues, point out to you where in the basically the Corporate Transparency Act statutory language, we find the discussions of this that are pretty clear, and then talk about why people keep making this mistake, because we're seeing it consistently. And it's becoming very worrying as we're getting closer and closer to the absolute first date everything has to be filed. So it is a concern. Well, one thing we did have this week was published in the Federal Register, RIN 1117, AB77, Schedules of Controlled Substances, Rescheduling of Marijuana, Notice of the Public Hearing. That notice was published on August the 29th. What's happened here is the DOJ has announced a scheduled hearing on proposal to reschedule marijuana, I might use the term schedule two different ways, on December 2nd, 2024. As we know, they had issued a proposed rule, and I think as we've discussed before, when we get outside of the IRS and rules under Title 26, Internal Revenue Code, generally Treasury uses proposed rule and rule for what we call inside the IRC, proposed regulation and regulation. So same difference there. So just like when you have a proposed reg, they have to open it up for comments, then they have to hold a hearing, and then after taking into account the comments they've received, plus the input they may receive at the hearing through testimony and the like, then they have to issue a final set, right? They'd come up and issue a final, or perhaps decide to go back and reissue regs. So that's what we have. Obviously, we have to have the hearing before anything can happen. So that puts December 2nd as telling us at the very earliest, sometime in December, you would get the final regs. These proposals would have a major impact on cannabis businesses in states where the sale of cannabis has been legalized. Because in those cases, remember, under 280 Cap E, we have a ban on virtually all business deductions except for cost of sales for any business involved in the trafficking of cannabis. That's one of the issues involved. And so there's a concern there about what's happening here. what's going on. In this case, we're having, we're also having another thing that's come up, the IRS has warned people about. There are people filing prior year refund claims. A cannabis businesses filing refund claims for all open years, asking for refunds based on be able to deduct these expenses, based on the theory that, oh, see, it's being rescheduled. The IRS is telling people don't do that. There may be negative consequences to filing that. The IRS may not behave well. And I think the other problem with filing that is you're likely to get a disallowance. And once it's disallowed, it's going to be a lot messier. So we'll have to talk about how that would work. But the disallowance is a problem, shall we say, for us in that structure. However, as was discussed a few weeks ago in the Tax Notes article, there are a number of attorneys who are suggesting that the businesses maybe should file protective refund claims. Now, a protective refund claim says there's nothing to decide right now, but this is merely protecting our option to finalize the claim once, in fact, we get this development solved. So if, in fact, they reschedule, then the theory being, we don't know yet for sure how the IRS will react. So the theory would be, well, assume, they might either decide it would apply retroactively, or if they decide it doesn't, then maybe you could persuade a court that it does with that law. My own take is I don't see it's likely it'll be retroactive, but it'll also say a protective claim doesn't in many ways hurt. So as long as you clearly label it as protective, I think that preserves your rights, even if you're not going to be the people to hold into court, should the IRS rule that only applies prospectively. And my reading of the statute would indicate that if I just take the statute at face value, it should apply only prospectively. As long as it was scheduled, it's on that schedule, those expenses should be disallowed. But again, are the courts going to agree with that? Is the IRS going to agree with it? We'll have to wait and see. So I understand why there's this argument about filing protective claims. So we'll keep an eye on that, but that's a different issue. Now, the real issue about this notice, so as I had said, some had been hoping this rule would be formalized before the election, right? Because the problem is going to be, well, and it's kind of interesting whether before or after the election is better or worse. If it's been finalized for the election, arguably it's better for the cannabis businesses because they have their answer. It would have been under the control of the administration that proposed the rule. And as I said, even though you might think it's unlikely that the vice president would decide against it, anything's possible. Who knows where it comes from, what her position might be. Because obviously one thing we know about vice presidents generally is they don't very often get consulted in any way that gives them any sort of veto power over a decision administration. They're supposed to go out and push it. So could we discover at the back end that as a former prosecutor, she sees this as a horrible idea? Well, we could, and also, when former President Trump was president, his first attorney general was definitely against anything of this sort. Now, later, after we got rid of him, after Attorney General Sessions resigned, left the post, that kind of big opposition to this seemed to have disappeared from the administration. And it didn't appear that the president himself, former president himself, had any feeling strongly on this. But we still don't know. Will they let it go forward? Will they not? It's tough to tell what would happen. So there is concern about it being delayed at this point, just because that's one more variable, and we don't know where those variables go. We do know, though, that I think, and the article concluded today, it's most likely this rule won't be finalized, until after the end of the year, nor would it be said, nope, we're giving up on this, nope, we're changing it entirely. All of that will go into the next year, which means the next administration, which also means if we do have probably not if you had a change from a Biden administration to a Harris administration. If you have one from a Biden administration to a Trump administration again, things new presidents tend to do automatically is, basically put a hold on the regs, right? That were issued late in the prior administration. So, yeah, we're not sure. And they won't move necessarily really quickly to finalize them. They want to have their own people review the reg, make sure that they're okay with it, because remember, it's going to go out now under their signature effectively, indirectly. Their Treasury Department, their Secretary of Treasury, et cetera, their signature. So there's going to be reviews there. So yeah, it's likely it will be delayed, and I would not be surprised to see it delayed until a few months into next year before we'll see it finalized. So that's a concern that people have about this. Now, as I said, a lot of this information came from an article in Tax Notes Today, which was written by Wesley Elmore. It was a hearing on marijuana rescheduling set for December. It was in Tax Notes Today Federal on August the 27th. I'm going to go look at that article. It discusses some of these issues in more detail. So basically, your action points right now, if you have clients that are in the business of, selling marijuana, under a state legal law, I would say most likely, you're probably going to sit tight for now. I certainly wouldn't tell the clients going to get a refund right away. You probably want to have a discussion with the clients about whether you want to do a protective claim. And if so, watch out for your deadlines here for when protective claims have to get in. We are heading toward the September 15th deadline for our pass-throughs and the October 15th deadlines for individuals and for corporations, C Corps. So, keep an eye on that because those deadlines will have to be worried about. But yeah, keep an eye on that, try to figure out where we're going, and we'll see how it runs from there. Now, as I said, it was kind of a light week in terms of things happening. I mean, there was a case introduced a split in the circuits about whether or not FBAR fines for essentially for willfully or non-willfully, or not, non-willfully or non-willfully, violating the FBAR reporting requirements. Should those be evaluated as a criminal penalty or a civil penalty for purposes of the Eighth Amendment, and whether it's an excessive punishment? We do have a split in the circuits now. The 11th Circuit has broken from the First Circuit. But again, that's kind of interesting. But since most of us don't have a whole lot of clients that are actually at this point, probably have these big FBAR fines coming up. And by the way, the guy that won the 11th Circuit, he just got one thrown out. There are still millions of dollars worth of fines that the court found. Yeah, that's fine. That makes perfect sense. Because he had sort of bad facts. So it was one of those odd things. So in any event, but otherwise, not a whole lot happened last week. Nothing that really was earth-shattering came out last week. Minor change in your rules for if you have short years involved in the transition under Section 174. They did clean up some mess in the automatic accounting method change that allows a short year return in the for the 23 or 24 tax years. To make the automatic change, even another return had been filed for those. We have another return had been filed for a year beginning in the same year. That's what I mean by short years. So those kinds of odd things we had fixed. But again, none of that's going to affect a huge number of taxpayers. Let's go on and talk about what has been a bigger problem for me. And this is a review of the beneficial ownership information issues. And there is a big concern, which is why I label it this way, as tax entities versus legal entities, among a lot of people, right? Regarding what is a reporting company, what's a reporting entity. And in reality here, the confusion I see quite often is CPAs and EAs are not thinking or don't seem to grasp the difference between a tax classification, which tells us which tax return this entity is going to file, and a legal entity. And that's important because, especially since Check the Box came out, we could have legal entities that are identical to each other, but which are taxed as different. Let's take a simple case, an LLC, a pure state law LLC, ABC LLC in Arizona. That could, for federal tax purposes, be taxed as a discard entity, which means its activity might be reported on the 1040 of an individual. It might be reported directly on an 1120 or 1120S if a corporation owns entirely parts of it. It could be reported on a partnership return. If the partnership owns it all, it could be reported on a trust return. If the trust owned all of that interest, right? That tax entity versus legal entities. And as I say, legal entities, LLCs, corporations, and similar entities that file with the Secretary of State are what we worry about for BOI. And the question comes up in the context of things like this. Well, my client started the year, they had their business, they're operating as a sole proprietorship. And, they had a single member LLC, they're operating as sole proprietorship. But this year they changed. Right? Let's say in the middle of 2024, they decided to file the revision, make an S election, and so effectively treat it as incorporating for tax purposes on June 30th. Now, now the people are thinking, well, wait, they were a sole proprietorship on January 1st. And then they converted and became an S corporation on June 30. So, do they have only 90 days to file? Would they not have had to file before, but now they have 90 days to file? Or let's say they were a partnership, right? LLC operating as a partnership. But then during the year, they decided to effectively convert to partnership status, or I should say convert to S Corp status. Again, do we have to file two different beneficial ownership reports, right? One for the LLC partnership and one for the, quote, S corporation, which, by the way, is really tough to say that way because, honestly, it's S corporation LLC, as we'll discover. No, you got one entity. It's going to file January 1st of 2025 is its due date, and we don't care what it did tax-wise. But you've got this problem, and every time I see it, it's just become more and more. And so I'm trying to emphasize to everybody, do not mix up tax entities and legal entities, right? That's crucial. The actual, Corporate Transparency Act is found in Title 31 of the United States Code, Section 5336, or, that particular issue. So that's where we're going to find this law, in Title 31. The Internal Revenue Code is in Title 26. In fact, it is all of Title 26. Title 26, United States Code, Internal Revenue Code are the same thing, right? Total identity. And yes, it's confusing with U.S. Code because ERISA is just part of the labor code, and that gets really confusing because the sections from the original act that established ERISA are often still referred to, in documents, in discussions, in articles on it. But there's a separate U.S. Code section, so things get messed there. But the thing to remember is we have two different titles, Title 26, Title 31. Definitions for Title 26, especially those in Section 7701, do not apply for purposes of Title 31, unless Title 31 specifically references them. Okay, and that's going to be key. So I don't care, right, what kind of tax it is. See, like corporation has a special definition that is unique to Title 26, found in Section 7701 of the Internal Revenue Code. And it's not the definition that if you look in your state law, there may be a title, chapter, whatever, that's devoted to corporations. What that title deals with and what that title refers to has overlap with what is called a corporation and what files 1120 or 1120S, federal tax purposes, but it's not the entire universe of entities that file for that. In fact, there are other entity types, other entity types that have their own provisions, their own title, or their own chapter inside of your state law, your state statutes, that are also going to file 1120 or the 1120S. So corporations, in terms of what files 1120 or 1120S, is not going to be the same as the corporations that file the beneficial ownership report. The corporations that file a beneficial ownership report will be a subset of those that file the 1120. Now, in most cases, they will still be filing a BOI report, but it's another entity type. But where it gets messy is when things that people think should file or things that people think shouldn't file. In essence, a lot of people think that everything that has a tax form should file, including trusts, and we'll get into that question too. The Title 26 only definition of what is a partnership. There is no reference in 7701 to a limited liability company. In fact, it is only mentioned with regard to certain like at-risk issues, as I recall, anywhere in the IRC or the regs, right? It's like payroll taxes, For payroll tax purposes, we do discuss LLCs in the regulations for liability purposes. But as far as income tax purposes, there is nothing ever referenced. There is no tax form to file for an LLC, right? There's no any sort of 1166 or 1066, right? Whatever you might call it for that. There is none. But your state law is definitely a definition of an LLC, so we need to be aware of that. The IRC definitions are at IRC section 7701 and the regulations under that section. And what's important to realize about those definitions is that 7701 begins by telling you, for purposes of this title. That's really important to understand, because the title in question, as I noted, is Title 26, the IRC. Title 31 is totally separate. So by definition, and 7701 tells you what's a corporation, what's a partnership, and therefore what files the 1065 series, the 1120 series, what files those forms. It does not address what files BOI, because those definitions do not apply outside of Title 26. C31, C26, those are two different titles. The definitions you use for tax purposes, the big ones under 7701, and that code section has a bunch of definitions that are used throughout the Internal Revenue Code, those override what would normally apply. Normally under the law, if there is a term used in a statute, you first look to see, is there a definition somewhere that applies to it? And, you could look inside of the section, which would override any other definition. It could be in a subpart, subchapter, chapter, whatever of that, title of the code, or it could be for the whole title. Or we could have a provision in the U.S. Code that applies for everything. But again, if there was a definition inside of it, let's say a title that disagreed with it, we'd use that one. Okay. So Title 26's definition 7701 are specifically restricted. They do not apply outside the IRC with an asterisk, as we'd always say, unless another provision specifically refers to them. Every so often, you'll see that in the IRC, where they will refer you to a section outside the IRC. For let's say, for educational institutions that qualify for assistance or for various programs, outside of obviously in health human services area. So basically, Department of Education area, I should say. Basically, yeah, they'll make cross references, but unless there's a cross reference, totally ignore 7701 and its related regulations, because they do not apply here. IRC 7701 is related regulations do not apply here. That means there is no such thing as check the box. And we don't care which box they checked. Purposes of the beneficial ownership information reports, we absolutely do not care what box is checked for the LLC. Whatever box it is will have no impact on its reporting, with only a few oddball exceptions, and we'll talk about that only because it's not so much whether it's a potential reporting entity. That's absolutely not dealt with by the IRC definitions. The only place IRC definitions come into play is qualifying for some of the exceptions. And then they are specifically referenced when we're talking about them for those exceptions, when they're specifically referenced to come in. Okay, so what does the beneficial ownership information reporting statute tell us? Well, a reporting company, there are two categories. So first thing is, it is a corporation, limited liability company, or other similar entity. Okay, so first thing is corporations, right? So now we're talking about corporations, and that term under the U.S. Code generally, the court's going to interpret that to mean a corporation under state law. That's generally going to be so. Whatever Arizona says is a corporation will apply to entities in Arizona. Whatever Florida says a corporation will apply to entities in Florida. Whatever New Jersey says a corporation will apply to entities in New Jersey. Okay, works simply that way. Limited liability company, and again, same rules there. What does the state say you have to do to be an LLC in that state? Those would be, or some other similar entity that is created by the filing of a document with the Secretary of State or similar office under the law of a state or Indian tribe. Now, most corporations, most U.S. corporations, U.S. LLCs are created. You have to file with the Secretary of State or the equivalent office. And I know those of you in Arizona, where I'm at, would be saying right away, wait, our Secretary of State doesn't handle corporations. I know that. So here, the Corporation Commission would step in for the Secretary of State for purposes of corporate type entity structures. That's just, okay? Understand that that is a similar office. Arizona does not give that to Secretary of State. Most states do. So do we have to file with Arizonans, the Corporation Commission, or Secretary of State, and then everybody else pretty much Secretary of State's office to create your entity? Because only if we have to file with the Secretary of State's office to create the entity, right? You don't have one until you have filed with Secretary of State's office or Corporation Commission's office here in Arizona. You don't have one of those. Those entities are going to be a reporting company. Now, whether that means they're going to have to report will be a different question, which we're not dealing with here today. Then you go into the 23 exemptions. If they don't meet one of the 23 exemptions and they were created by filing a document with the Secretary of State, then they're going to have to file. Or formed under the law of a foreign country and registered to do business in the United States by filing a document with, again, the Secretary of State or similar office of a state or an Indian tribe. So for the most part, again, these are the requirements. You notice here, please, it doesn't say anything about the IRC. It never mentions the IRC, never mentions Title 26 of the U.S. Code. Makes no mention whatsoever. Those definitions do not apply. And second, remember, it needs to be an entity. That's also going to be somewhat important. Right? An entity under that definition, because if it's not an entity, it wouldn't count. And, and it must be one that requires filing with the Secretary of State in order to form the entity. It is created by filing. You aren't just giving notice to the Secretary of State that you have this thing here and running. You're rather saying doesn't exist at all until we do something about that. That's the big difference. Okay. Now, these terms found at USC 5336A11 are not otherwise defined in the law. And the final rule only repeats what you just saw in the statute. So if you go look at the equivalent, the regulations, you got exactly the same definition. Nothing was changed, right? Because that's relatively straightforward as far as they're concerned. Definition, the code, basically the statute gives us a very clear definition of what is a reporting entity. Right? Must be an entity, must file with the Secretary of State's office, and must be similar to a corporation or LLC. That's basically it. And those state laws, basically define the terms corporation and LLC. In fact, generally there are broad sets of statutes to define these and similar entities. Some of the similar entities in most states, you normally have to file Secretary of State's office to create a limited partnership. That puts creditors on notice. You don't have to do it for a general partnership, though. Normally, general partnerships do not do it. If you and your buddies just get together and start conducting business together as a group, you're a partnership under state law, but you don't have to notify anybody that you're a partnership. Okay, I know you're going to have to get an EIN from the IRS, but they didn't say IRS, it said Secretary of State. So you have something there, but yeah, it doesn't count. But like LLPs and all of those things, yeah, they're probably there, and some of the other various variations. The key things to remember is these definitions under the Beneficial Ownership Information Report are not controlled by the IRC and the regulations under that title. So ignore, forget everything you know about tax filing and what an entity is. We need to get to the legal entity. Now, it's concerning that we have this problem, though I kind of understand why we do. Okay, but we'll get that in a second. You are definitely asking the wrong question if you ask. Let's put it very simply. These are all basically This is like asking, I don't know, something just totally absurd, would you, would you like to have, Beethoven's Fifth Symphony for dessert? It's like, what? The pieces don't make any sense together, right? And that's what we have here. They don't make sense together. If you're going to ask, don't ask, and I've seen this asked, does a sole proprietorship need to file a BOI report? Well, sole proprietorship is really more kind of a tax concept, which is an individual owns and runs. And the other problem is what you report on Schedule C or for rental Schedule E can be a pure legal structure style sole proprietorship, which is where the assets of the activity are all basically in the name of a single individual, directly in their name. If I go look at the title on your rental property, it says John Doe. It does not say John Doe LLC, right? The Doe LLCs. It won't tell me that, or the Doe Fifth Main Street LLC for that one property. So again, that question is nonsensical, cannot be answered as asked. Similarly, does an S corporation or C corporation need to file a BOI report? As if there'd be a different answer. And the answer is, you get rid of S or C. Your only question is this a corporation? But even if it's not a corporation, but is filing those tax forms, then your next question has to be, is it an LLC that checked the box? But LLCs and corporations file. But there is nothing special about having made an S election, nor does that change the entity. Right? For taxes, it's considered as if we pretend it's a brand new entity. But gang, please remember, it's pretend. It is not a new entity. The entity stays the same. It's only a new entity in the view of the IRS because we are, to quote what I've quoted from Jim Hamill a couple of times, we're lying. That's a total lie. It's the same entity. But for tax purposes, we're going to live the lie, and we're going to go ahead and say, hey, this LLC is taxed as a partnership, or this LLC is taxed as a C corporation, this LLC is taxed as an S corporation, or this LLC is a discarded entity, and the party that owns this LLC is a individual, or a corporation, or whatever. But the entity that I'm looking at right now is an LLC. And it could be filing, essentially, its information can end up on every type of tax form that exists. Because if a trust owns an LLC, a disregarded entity, an LLC treats a disregarded entity, then we're going to report that activity of the trust as if, of the LLC, as if those assets were owned directly by the trust. Right? So again, not really one that makes sense. Or does a tax partnership need to file a report? Again, that's a tax definition. Rather, we need to get, and remember, a partnership for tax purposes could be a LLC. It could be a general partnership. It could be a limited partnership. It could be a limited liability partnership. It could be like here in Arizona, you have professional liability corporation, not private liability company, not corporation. Make the mistake all those who are not trained in the area make of using corporation and everything, but a PLC. It could be any of those things, right? So again, I can't tell you if you need to file or not. If you just tell me it's a partnership, it follows a 1065. My next question is, well, what type of entity is it, or is it an entity, right? Is this a general partnership, a limited partnership, an LLC? What type? Because just telling me it's filing a 1065 tells me nothing. It gives me a range of entities that could be doing this, but it doesn't tell me what entity it is until you give me more information about that. So all of these are wrong questions, right? They're in many ways nonsensical questions. You have to understand that you're asking totally the wrong question, right? So rather, the state law entity formation statutes are what control in this instance, because that's what FinCEN's looking at. An LLC that can't meet an exemption will be a reporting entity, and that doesn't matter. It doesn't matter who owns the LLC. right? It doesn't matter if it's owned by a person, a trust, a corporation, owned by 5 people, owned by 2 corporations and 3 people. None of it's going to file, right? Unless it can meet an exemption because it's an LLC, not because of any of the tax treatments, right? So that's it. LLCs file, period. Unless you have some really weird statute, some really weird structure in your state where somehow, under some circumstances, you can form an LLC without ever notifying the state. You create an LLC, which seems unlikely, right? Basically, they all have the reporting statute because generally the idea is we want to make sure that creditors, potential creditors, can research and figure out if they're dealing with an LLC, because that's a liability situation where maybe I need some guarantees, or I wouldn't loan the entity by itself. Similarly, a state law corporation is going to be a reporting entity if not otherwise exempt. And please remember, when I say state law, I'm not talking about state income tax law, right? Under Arizona state income tax law, I'll use Arizona because that's where I'm at. If you're a corporation, if you've checked the box and become a corporation for federal law, for purposes of your filing tax returns federal level, then you're going to be a corporation for Arizona income tax rules. But that doesn't mean that if I go to court, let's say I'm suing the entity in a liability case, right? When we go to court, the court won't really give a darn what his tax filing status is, right? I'm suing there for damages because they were negligent. It's going to care what legal entity type it is, right? The judge really won't care what tax return they file. It's like, that's absolutely irrelevant information. Why would I care? I need to know it's an LLC to apply the law related to LLCs in Arizona to see if, liability can escape the LLC. Just like if it's truly a corporation under Arizona law, I'd apply the corporate rules to see if we can pierce the corporate veil. I wouldn't care what type of tax. I don't care if it's a 10. I don't care if it's 1120, 1120S. That doesn't matter to me, right? Again, keep that in mind. We're looking at entity types. In essence, to phrase it one way, remember when you went to college, if you took you're in a business curriculum like I was, my accounting curriculum, we had to take the business law courses. We took business law. So did everybody else in the business college, right? Now, those people they never took any of the other courses that we had that went into tax reporting. Only what they learned in business law, in that business law course, is really relevant. Those entities are what's relevant for this purpose, not the entities we talked about in tax courses on the accounting side. So keep that different. That's kind of where we are. So the basic rules here, we have this chart that is in the FAQ on the FinCEN website for the FAQs. This particular chart says, under what law was this formed, right? If it's U.S. law, we go to the left side. If it's a foreign company, we go to the right side. First question, right? Is this company a corporation? Yes, it's a reporting entity, unless there's an exemption. Okay. Second, is this an LLC? Again, yes, then it's going to go into the reporting. If no, it may not need to file. Now the third test. If you go to the third test and we're still, no, you're not a reporting company. Nothing else matters. Don't worry about exemptions or anything else. We're done. You're over. Are you a similar entity that, essentially had to file with the Secretary of State in order to be recognized as coming into existence? As I say, quite often that will include things like limited partnerships, LLPs, various other structures. You have to file with the Secretary of State if you do, or equivalent office. If you do, you're going to be a reporting company unless you can meet an exemption. And then if you get all the way down to that last no, then you get to the red box. You're not a reporting company. Doesn't matter. Nothing else matters from this point forward. You're not a reporting company. If it's a foreign entity, then we look at whether you have to, whether you had to register with the state to conduct business in the U.S. And if you did, then you're considered a foreign reporting entity, and then you're going to have to file a report. But if not, then you're not a qualified entity, right? You're not a reporting entity. So that's kind of important to keep straight, right? Keep this together. And notice nowhere in this chart, and you go look at online, again at the FAQ site, which is at fincen.gov/BOI, which is beneficial ownership information. There are FAQs. You'll see a little link in the middle of the page. You go there, you will go look at reporting companies, and you'll see this flow chart available for you. So you have that there. That's how it works. Okay. Now, I guess the real question becomes, why do we have this problem? Well, what we have as a problem right now is, I think there is a tendency among us to want to avoid ever looking at the law, and rather we just want to, kind of memorize this set of rules. And the theory is if I memorize every rule, and so I can memorize these, I'll write those rules, because I don't like to call them laws, because laws are complicated, so I want to memorize those rules. So I've just learned rules. I've never really understood why the rule is, I just know there's a rule. But where it comes from, the scope of the rule, or any of that stuff. We've eliminated those issues. By doing that kind of way of learning things, I think you set yourself up for a huge failure when something like this comes in. Because you have to understand the scope of anything. Now, you also set yourself up for failures inside the IRC itself. Because even though I said 7701 said these definitions are for purposes of this title, there are way more definitions than we find in 7701, and those may be for purposes of this part, this chapter, this subchapter, this section, or even just this subsection. This definition applies. In fact, what we just saw in 5336 was for those definitions I had there for what a reporting entity was, reporting company was, that definition is only for purposes of Title 31, Section 5336. Those definitions apply to nothing else. You see, another section of the code, another section of the U.S. Code could use the term reporting company to have a totally different meaning. So you got to be aware of what the scope is. Scope of definitions is crucial to understanding this. Whether we like it or not, you've come into tax. You're in tax, you have to deal with law. If you don't want to deal with law, then go back. You got to go back to A&A, right? Basically, do A&A work, right? Just do the FASBs and stuff. There, you got to memorize that stuff too. So you'll find that the rules theory doesn't work well there either. But if you don't want to take a look at law, then tax is just not your thing. We can accept that. But if you want to do tax, you really do need, especially if you're doing anything at all complicated, you need an understanding of the law. That's where we run into trouble. Now, other thing I see confused a lot is, again, is when we talk about ownership under the Internal Revenue Code, we generally are looking for, we don't care, if I'm supposed to disclose owners, I'm going to take a look and, consider every type of owner, whoever has an equity interest, if that's a corporation, if that's a trust, if that is a, partnership, whatever that is an owner of my entity, right? And while sometimes I worry about, well, who owns an interest in that? I look through that under rules like attribution or related party rules and all of those sorts of things. I look at everybody. The most important thing to remember about this statute is, and again, it's inside of its definitions, right? 5336A3. We're at A11 for what is they consider to be a reporting entity, a reporting company. Or at A3 Cap A, that defines a beneficial owner. And the first thing it tells you is a beneficial owner is an individual. Read the statute. Corporations are not beneficial owners. Trusts are not beneficial owners. Partnerships are not beneficial owners. Now, that's important to understand. They don't report as beneficial owners. In fact, if you try to do the form, it's going to kind of basically come down and point that out to you. Anything or an individual cannot be a beneficial owner you're going to report. But you are looking for indirect ownership or control. That generally means if somebody has ownership or control of the thing, of the, let's say, that entity that owns an interest in the reporting company we're looking at, that may give that person, through that indirection, control. So they could have substantial control over their reporting company, or they could have ownership, right, under the greater than 25% ownership rule. Generally, for ownership, we're going to use proportionality here. If you hold 100% of the, let's say 100% of the stock of a company that's a trust company, right, then by definition, you're going to be considered to own, or be considered to be essentially indirectly owning, because as trustee, the trust company, you control the company, which is the trustee of these trusts. Well, that'll make you the essentially beneficial owner of assets inside every trust that's that's basically who's trusteed by your trust company. And therefore, you're considered to own every share of stock or every percent interest of an LLC that the trust you have in your portfolio have. So we're going to start looking at things like that. And by the way, that example comes directly from the FAQ's discussion of trusts. Trusts are messy, but we have to look through them to find ownership. By the way, this is where it gets complicated, and where I think you can very quickly run into situations where you better get legal counsel involved, because that's not something we are trained on, right? This is not attribution rules. This does not follow the IRC. It's got its own set of viewpoints here. And I think when you have tough calls there, you got to kind of go that route and go with this, right? Okay. So here's the catch. The following will normally not be a reporting entity. So let's summarize this things what we look at there. A sole proprietorship where all assets are owned directly by the individual, not via an LLC or similar entity. That will not be a reporting entity. We're done. A general partnership as opposed to an LLC, an LLP, a limited partnership. I'm talking about your flat general partnership. 3 guys got together, bought a rental property. They never talked to any attorney, right? They found a partnership agreement on the internet. Never heard of LLCs to put this in for liability protection. That thing's not filing, right? The Jones Smith James LLC, or not Jones Smith James Partnership, not limited partnership, right? Not LLC. Their partnership is not a reporting company. It doesn't have it. Most trusts you deal with are not reporting entities. They are not formed by filing with the state. I'm currently in the middle of dealing with, my father passed away recently. We're dealing with his trust, what had been his revocable living trust. Now, of course, it's no longer revocable. So now we have again, that's another case where the IRC, under state law, nothing really changed there except the trustee. But under federal law, suddenly this brand new trust sprung into meaning. But again, somewhat irrelevant. That trust never, state of Arizona knows nothing about that trust right now. Right? Essentially, it's not the first time it's going to find about that trust is when the Arizona Department of Revenue gets a trust return this year. Right? It'll learn about the trust. Otherwise, the trust has never really had to file anything with it. It was reporting under my father's Social Security number. So yeah, it's kind of tough for the trust. And yeah, the state might be able to figure something out. And they looked at 1099, so I'm never quite sure Arizona does. But, that'll be one of the things that could be done. But yeah, the trust doesn't. Right? Most trusts are not done. And they're very clear. No, the mere fact that it might have to file with the probate court, maybe get hauled into court, that's not a fine. It didn't create the trust. That's a different issue. And that's a different concept of doing this, right? So trusts created in the state generally come under the jurisdiction of the probate court. So if any disputes arise, you'll be in front of either a true probate court, if the state has those separately. Most states don't. So it'd be in front of a court. We call it a probate court, though, because it's hearing a probate case, which includes trust cases generally. Okay. The key issue is none of those are normally formed by a filing Secretary of State or the equivalent office. Okay. Now, there are some things that are created by filing Secretary of State that would not normally be considered an entity. That is, the statute has no special definition of entity. My example of that, and again, there are some that get nervous about this. You're going to want to file based on, but I think then you get into a circular argument about, you're asked to put this on the return for every entity. What are your trade names you own? Now, if a trade name by itself qualifies as an entity, then, and let's say that your entity is not exempt, not a large operating company, it's not otherwise exempt. So then all of your DBAs not only have to be listed on the report for the LLC or corporation, but they have to file their own report, which then raises the question of, well, if you go by 3 different DBAs, these your DBAs have to list the other 2 if you're filing that way. And I'm saying that seems just totally absurd. I'm saying that that's more like a trademark, right? That is something an entity owns, right? You own trademarks. You own trade names, right? But the entity is still the Smith Jones LLC. Even if it's doing business as, let's say Cave Creek Amusement Park. Fine. That's its DBA. But the legal entity is still the LLC. That's a different concept there. Now, there are some cases where certain trusts, limited cases trusts, so I say most trusts, some trusts, especially that are investment style trusts, they may, under the state's investment laws, have to register with the state. If that's true, just like limited partnerships do, then that would be a reporting entity. But like I said, your bypass trust, your Q-tip trust, your survivors trust, your charitable remainder trust, that's going to be a really odd situation where one of those becomes a reporting company. But you do have to worry about anything they own. If they own any interest in a corporation or an LLC, then we may have to look through that trust to figure out who's deemed to own those interests that the trust owns, and therefore report back up the line. So they might have to be a beneficial owner of the entity's own. So for instance, let's say my father had owned an S corporation. He didn't. Let's say he had. Well, then we'd be looking inside this trust for the S shares, but his trust is not the beneficial owner. Assuming it wasn't exempt, then we'd next look at, well, what about the trustee? And under the rules, would the trustee have the right to sell those? Yes, under my father's trust, if an S Corp shares existed, the trustee would have a right to sell them. So the trustee would be able to, and the trustee is my brother. So basically, he would be listed as a beneficial owner because the assets, the shares are inside there. And it wouldn't qualify for special probate exemption because these aren't going through probate. They're inside this trust, and the trust rules come into play. There's a special probate exemption. I think we talked about on some of the BOI discussions that got us a special rule for a true probated asset will not have to have a new BOI update until we send the thing back out to another person. Because that's really what probate's trying to figure out, who's going to be the owner of this asset. So it becomes kind of an absurdity to try to figure out, who's the beneficial owner. But trusts are really very simple, right? General rule for trusts, look at there's lots of interesting rules of trusts. But on the very basic level for straightforward trusts, you would probably be looking at the trustee. As long as they have the right to sell the asset, the trust doesn't bar them from selling it. Or anybody who has a right to sell the asset automatically. You look at, if you're talking about 100% grantor trust, the grantor will also automatically be the owner. That is one point we look at that. Now, it doesn't say grantor trust. What it says is if anybody has a right to essentially take assets out. Now, we know that will make it a grantor trust as well. But again, this reference is not going back to code. It's coming up here. Do you have a right to grab it in? So, by the way, some intentionally defective grantor trusts, the grantor won't be the owner. They won't be for federal tax purposes. They won't be for BOI purposes. They couldn't be the beneficial owner, right? And if there's only one beneficiary of the trust, that will also be the beneficial owner, right? Those sorts of backgrounds. And there are other rules and considerations to make in there. Just be aware it gets messy. But that's kind of how you do this and how you handle it, right? But if a normally exempt entity is created by a finance secretary of state, then it would be reporting. That was what I was just discussing. A very limited number of trusts do qualify for this, but they're very, very limited and only in certain states. So again, be aware of that. If you got one of those oddball trusts, that's the time you better be getting legal counsel. You got a complex trust with terms and you can't really figure out who has a right to do what. You better get the attorney in the room. preferably the attorney that drafted the trust, because we need to figure out, what rights do these people have, and therefore who should be a beneficial owner coming out of this thing. Also often misused are various attribution rules. Again, nothing in the Corporate Transparency Act cross-references any IRC attribution rules. So they're not there. Now, you do have to consider indirect ownership, or indirect control. So certain relationships, I would say having shares owned by your son, in the Internal Revenue Code, that you got enough shares owned by the son, you could be deemed in control of the company. But with this, you would probably need to not only have them owned by the son, but have some sort of formal or informal arrangement where dad was going to be able to call the shots. If you have that, even informal ones, even ones that are verbal, would come into this area. And again, if you're in those sorts of situations, seek legal counsel. I'm going to remind you of that, right? There are some complicated things. As I said, ownership of an entity most often is deemed to grant a proportional interest in whatever it owns. So like I said, if you own a C corporation, it has an LLC. You own 100% of the C corporation. C corporation buys basically has an LLC. And it's a wholly owned LLC of it. Well, you're going to be the beneficial owner of not only the C corporation, but also that LLC. And assuming neither one is exempt, then there'll be two reports, and you'll be listed beneficial owner on both. The way it works, right? Keep those things up. Like I say, be careful here. And remember, this is not part of the Internal Revenue Code. Do not confuse. Do not apply IRC structures. Do not even think IRC structures. Only when we get to exemptions. In very limited cases, like for the person being a large operating company, it specifically refers you back to gross revenue based on tax returns. So bingo, that's IRC governed. We talk about also there, we're going to start counting employees based on regulations that were under the Affordable Care Act for an Apple large employer and what's a full-time employee for a month. Yeah, so good. We cross-reference there. And we talk about certain tax-exempt organizations. Part of the cross-reference of what's an exempt organization, tax-exempt organization, is going to be cross-referencing certain 501c provisions. And so, if you're under there, and that again, specifically cross-references the code, but unless it's specifically cross-reference, don't use the Internal Revenue Code. Simple rule. Well, this has been the update for this week for current federal tax developments. Ed Zollers, I am still, as I said, email address edzollers@currentfederaltaxdevelopments.com. I am monitoring posts on the Arizona Society forum, Arizona Society, should say Connect forum, that for New Jersey Society, Minnesota, Illinois, Idaho. So, keep your eyes there in Washington. If you have any questions, if you ask questions there and I see them, I may respond to kind of fill in. Otherwise, take care. Remember, your deadlines are coming up for September 15th, so keep that in mind. Hopefully you don't get too swamped for the next couple of weeks. Remember, we got a couple weeks to go, and then it's all supposedly done. I would say supposedly because it seems like as soon as October 16th shows up, a bunch of other things show up to happen. But nevertheless, still, we got a little bit of time there before this all is done. But yeah, we'll get October 16th, which then gives us a whopping 2.5 months before the next tax season begins, as we end the calendar year and start filing season in January. So on that upbeat news, hopefully we'll see you back here next week for more current federal tax developments.